I opened the statement. Not a trading account, not some aggressive growth portfolio I'd been reckless with. The retirement account. The boring one. The one I was supposed to basically ignore until I was old. And sitting inside the section labeled fixed income, the part that was supposed to be the seatbelt, was a number that made no sense to me. Negative 19%. And the crazy part is, it wasn't crypto. It wasn't a bad tech bet. The thing that wiped out nearly a fifth of this portfolio was bonds. The one asset class that every advisor, every brochure, every retirement calculator on the internet treats like it basically cannot go wrong. But I found a number buried inside that fund, 3 digits. And once I understood what it meant, I realized the risk was never hidden at all. It was printed right there on the fact sheet, in a number nobody told me to look at. I want to tell you about David. David is 54. He lives outside Columbus, and for the past 25 years, he has been, genuinely, the most disciplined saver his financial advisor had ever seen. Maxed his 401k every year without fail, never touched it, never panicked. And heading into 2022, David actually felt pretty good about where he was, because he'd spent the months before doing something he was proud of. He'd quietly shifted 45% of his $680,000 into bonds, away from the volatile stuff, into the safe lane. He watched the stock market get choppy and thought, good thing I moved when I did. Then he opened his Q4 statement. His stocks were down. Fine, he'd expected that. But his bonds, the part he'd deliberately moved money into for protection, were down 18%. He called his advisor, asked what happened, and the advisor said something David will never forget. That's just how bonds work when rates go up. David sat with that for a second, and then he said, why didn't you tell me that before I moved everything into them? There was a pause on the line, and that pause cost David $55,000. Here's the thing. David is not a cautionary tale about one unlucky guy. David is 70 million people. That is the number of Americans currently inside employer-sponsored retirement plans, and most of them followed the exact same logic David did. Get older, get safer, move into bonds. Because that is what every piece of financial guidance tells you to do. But the guidance skips a step, a critical one, because there is no such thing as bonds. There are short-term bonds, which barely move when interest rates change, and there are long-term bonds, which can swing violently, losing 15–20% in a single year. And the number that tells you exactly which one you're holding, the number that measures your real exposure to interest rate risk, is called duration. Your financial institution knows this number. It's on the fund's fact sheet. They just never built a system that makes you look at it. Because complexity you don't understand is worth a lot of money to the people managing your complexity. Okay, this is where I need you to stay with me because this math is going to hit you somewhere specific. A bond fund with a duration of 8 loses roughly 8% for every single 1-point rise in interest rates. In 2022, rates rose 4.25 points. 8 times 4.25. That is a 34% loss on a fund that was supposed to be safe. Now let's do David's math. $680,000 in retirement savings, 45% in bonds. That's $306,000 sitting in the safe allocation. Duration, 8. $306,000 times 34%. That is $104,000 gone from the part of his portfolio that was supposed to protect everything else. David contributed the maximum allowed amount to his 401k every single year. The IRS limit in 2022 was about $20,500. That loss represents 5 years of perfect maximum contributions, wiped from the safe sleeve. Most people hear David's story and land in the wrong place. They think 2022 was the freak event. The Fed panicked, rates spiked, it's over now, won't happen again. But that misses the actual problem entirely. The risk was already inside David's account before 2022 started, before the Fed moved once, before anyone wrote the word inflation in a headline. The duration was already printed on the fact sheet, sitting there, building exposure, silently every single month he held it. 2022 didn't create the problem. It just made the problem visible on a statement. And here is what you need to understand about right now. The US government is currently paying over $1 trillion a year just in interest on its own debt, not building roads, not funding schools, just the minimum payment on money already borrowed. To keep attracting buyers for that debt, rates have to stay attractive, which means the environment that broke David's bond fund isn't some closed chapter. It is the chapter we are still in. If you're 52, 55, 58, sitting in a target date fund you've never actually opened, that duration number inside your account is a ticking clock. And unlike David at 30, you do not have 25 more years of contributions to dig yourself out. Nobody is going to call you about this. Your HR department is not sending an email. The fund company is not flagging your account. Your advisor, if you have one, is managing dozens of clients and is not losing sleep over your specific duration number tonight. They'll describe your fund as age appropriate. They'll show you a chart of a smooth glide path. They'll use language that is specifically designed to make you feel like a competent professional has thought carefully about your situation. And all of that may be technically true, and it still leaves you holding a number that could devastate the last decade of your working life. The bond market took down Silicon Valley Bank in 48 hours. Not crypto, not fraud, bond duration, operating exactly the way it was always designed to operate. It forced a British Prime Minister out of office in 45 days, the shortest tenure in British history, because bond traders decided her fiscal plan didn't work and dumped her country's debt until she had no choice but to resign. It erased 39% from long-term U.S. Treasuries in a single year, the worst performance for those bonds since 1754, before the United States was a country. This market is not gentle. It is not abstract, and a version of its mechanics is running inside your retirement account right now, attached to a number you've probably never seen. Here's what you do with all of this. I'm going to show you exactly where to find your duration number. It takes 3 minutes, and I want you to do this while the video is still playing. Log into your 401k, find the bond fund or target date fund you're in. Grab the ticker symbol, 5 letters, usually ends in X. Now, when you land on the fund page, ignore everything at the top. Seriously, the performance numbers, the star ratings, the pretty chart, all of it. It's designed to hold your attention away from what actually matters. Scroll down. Keep going. You're looking for a box. It'll say portfolio statistics or fund characteristics. It might be small. It might be easy to miss. That's not an accident. Find the line that says average duration or effective duration. That number, that one line, that is the actual risk label on everything you own in this fund. Not the fund's name, not the word conservative in the title. That number. Here's how to read it. Under 3, you are largely protected from rate swings. Genuinely low risk on this dimension. 3 to 7, moderate. A 1-point rate rise costs you 3 to 7%. Manageable if retirement is still years away. 7 to 12, pay attention here. A 1-point rise hits hard. You need to know if this is where you are. Above 12, you are making a significant interest rate bet, whether you meant to or not. If you're within 10 years of retirement, this is the conversation you have with an advisor this week. Not eventually, this week. Because the difference between duration 3 and duration 12 in the rate environment we're sitting in right now is the difference between a small dip and losing half your bond allocation on the part of your portfolio that was supposed to be the safe part. Here's your one action after this video. Open your 401k, find your bond fund or target date fund, Google the ticker, find the duration, then come down to the comments and drop just the number. That's all. No explanation, no context, just the number. I'll be reading every single one because now you understand what it means. And the bond market is going to keep running either way, pricing your mortgage, your future, your retirement, whether you've looked at it or not. The only question is whether you find out before the statement arrives.